much for this stuff?
Must be joking. Only nutcases can buy that stuff. Isn't worth anything.
It's a bit crazy. It's new and I bought it here.
Well, that stuff's worth something. Only on the point. Passes from me to you. Before that, it's liability. After that, it's useless. Look, sweetheart. I show you what this is worth.
Let's just get the transcript up of that, and I'll just complete a little introduction here. How much for this stuff? So this is the film Ghost Dance from 1983, made by Ken Mullen, and it's a interesting film. It's a sort of philosophical art film. In fact, Robbie Coltrane's in it, funnily enough. So the shopkeeper of the tech store is asked by the customer how much for this stuff, and he advises her that it's worth something only on the point it passes from the seller to the buyer, and after that point it's a liability and worthless. So this is a point about the economics of consumerism, consumer goods, but applies equally well to money as a commodity. Now, I'm playing this clip in the context of monetary values applied to property values. Now, this is a consumer product here, but hands-free phone from the early 1980s. Now, property is a physical asset. It's worth something to live in a shelter or to rent out and receive rent. Money is a token by which we place a monetary value as an intermediary value so that different properties can be compared against each other in terms of a monetary price. So that monetary price of that token, the pounds, shillings and pence price of a house, is what all the fuss about is at the moment, about interest rates going up and affordability of houses in terms of monetary values, wages, disposable incomes and all of that. Now, underneath that, the money that's created to buy houses is all created by the banking system as debt on the one side of the monetary transaction. A loan of from a bank to a customer is an asset. For the customer, it's a liability. Now, when you deposit money with a bank, the money that the bank holds and you transfer ownership of that money to, that's a bank's liability to you. Now, in terms of transferring property, etc., a mortgage on a property is an asset to a bank and a liability to you. The security for you receiving the monetary part of the mortgage, which is your liability as the bank's asset, the property value then becomes an asset to the bank. So that's the security. Now, how all of that plays out in terms of a cui bono, or who benefits aspect to what happens if the price of money goes up, i.e. interest rates go up and property values go down, is an interesting question. And that's what I'm gonna examine in these windows that I've got open coming up. So I'm going to just go through the tabs in my screen as I go along. And the first one is this one here, which a freedom of information request on housing wealth in the UK and solvency ratios of banks. So banks are required to meet targets of what's called the Basel III Treaty, and within that treaty, after the financial crisis of 2008, it was decided that banking institutions should hold collateral or assets to make future lending, and mortgage assets are a large part of what makes up a bank's balance sheet. So to give some idea of context on that, I think I may have done the calculation here. Yeah, here we are. So mortgage loans make up 57% of total banks' risk-weighted assets and 78.4% of the credit and counterparty risk component of banking sector regulatory capital requirements. So that's in a blog which I posted on June the 5th, 2023. Okay. So the blog I did the day before this, so my blog yesterday goes into more detail of mortgage lending as a major component of the money supply. Money is not a stock, but a flow. But the flow is regulated by the core debt upon which banks' weighted risk assets are based, and hence the key component of bank solvency is actually house prices. That's a key point to if house prices fall below a certain level, where does that leave the banks and their solvency? Rule changes are always a possibility, but it's an important point. So in Q4 2022, all residential mortgage loans were about 1.676 trillion. That's 1,676 billion. And they'd gone up 3.9% on a year earlier. So this is Q4 2022. Now that was secured against, this is using Savills figure for January 22, about 2.9 trillion of property value. That's mortgaged property value. Okay, and that's a 57.7% loan to value across the board for all bank lending into the mortgage market. So I then in that blog go on to do the calculations of if nominal property prices drop by 35%, where that would actually leave the banks in terms of their loan book. And the answer was that the loan to value ratio would actually increase to 88.9%. Now, the amount of mortgage lending that's done above 90% is very, very small, and above 95% is absolutely minuscule. That talks to the stress testing point that people talk about. Effectively, banks do most of their mortgage lending on to house movers and people with a high level of equity. Now, your equity in your property is not what the bank focuses on in terms of their what's of interest to them is how much of the money they're loaning is at risk, and the answer is not very much. In fact, banks don't have a lot of skin in the game when it comes to the mortgage market. And that's this point here about skin in the game and moral hazard. Now, Nassim Taleb in 2009 made the claim that the banking sector in the last global financial crisis lost in 18 months the equivalent of all the banking profits ever made in the whole of time. There's a link in the blog going on about how that's justified. I mean, I was fascinated by that at the time and went into some depth. So these are common equity tier 1 capital ratios of JP Morgan, Goldman Sachs at the time of writing, which it was in July 2015. So that's kind of what I'm going to just build up some of the questions that flow from that claim about what is mortgage debt, what it is to the bank in terms of an asset, what it is in terms of you to a liability, and how that translates to who's got what's got skin in the game, and what the effects of monetary policy actually are. So let's just go then to the next tab. So this was a correction. I had some correspondence about a Freedom of Information request to the ONS, Office for National Statistics, about housing wealth figures per percentile in the UK property market. And so at this point, what I'm going to do is just find this spreadsheet here. Oh, where did I have that? Is it? That's the percentile wealth. Is it? It's possibly under here. No. Bear with me. Stock a person. No. That's not the right one. So I can't see it open. Yeah, here we are. This is the one here. So I made a calculation about what the minimum average replacement cost for the fictional average property in the UK would be. And this data here is to do with salary percentiles, which you can see when you get from 75 and above. For instance, the 82nd percentile average salary is £46,400 per annum. And the average property wealth is that right? All right. So I worked out what 5 times the average salary we get to. So it's not until you get to the 82nd or the 83rd percentile that one salary would buy the average property at £237,548. Now, there are lots of dynamic things going on all over the place in this game of house prices, where they may be headed, who would benefit from them heading in any particular direction. The main takeaway that people should have is that the Bank of England's single remit is to keep inflation at about 2%, and things like unemployment or house prices and all the rest of it are kind of incidental to do that. They're all just levers which can be pulled to hit that one metric, and the efficacy of that metric is something we'll come up later, and I'll just make a comment about that. So this graph here shows that in 2016, in real terms, the average cost of a property was £227,000, and so if the fictional affordable home now is £237,000, it's back to 2016. I did comment in a blog that these views are all effectively just opinions based on taste or art wherever you pitch them. Now this is on my business blog, and let's just get to the title here. Here we are, UK property by tenure. So this is just by way of a little more context. So we're viewing this actually online. Well, that's a bit slow loading. So that's the bit I was just saying about loan to value ratios if house prices did in fact fall 35%, and then looking at different monetary measures and how I calculated those percentages. Housing value breaks 8 trillion barrier. That's the Savills figure from January 22 is 8.6 trillion, of which the mortgaged value is, or outstanding, so the outstanding values of 1.675 billion is 2.9 of that. 2.9 trillion of that 8.6 trillion is actually mortgaged. So unmortgaged property is by far and away the biggest sort of center of gravity, if you like, whereas all of the pricing information tends to look at the mortgage market, looking at the margin, if you and the belief is that small changes at these margins affects the gravity of this big chunk of wealth, and this fact here, this is 53% of property in the UK doesn't have a mortgage, but of that 53%, it actually makes up the substantial part of that 8.6 trillion, and 2.9 trillion of value is mortgaged at about 53%. Now, in terms of ratios and what has to happen in that mortgage part of the market to affect the center of gravity of the owned market, as it were, is where the stickiness comes in prices. Going down is a slower process than going up, simply because the choices of people without the influence of the lenders or the banks are rather different, which is actually a good argument in favor actually becoming a homeowner outright, which at the end of your mortgage period, that's, you know, the general objective. So that's that point about centers of gravity. In terms of panics and fear, uncertainty and doubt, there's a lot of that going on at the moment. So this article, for instance, here is quoting two property experts. I use that term advisedly. Here they are here. This guy, Rob Dix, who I've never heard of. This guy, Charlie Lambdin, who I'd never heard of, but started appearing in my feed. And let's put it this way. This guy's kind of like the Michael Moore of climate change, and this guy's like the equivalent in the property market of Greta Thunberg. So Charlie Lambdin is the new Greta Thunberg. of property punditry. And this guy here, we'll call him the I think he's called Michael Moore, it might be Richard Moore, the founder of Greenpeace, who has a an ecological realist stance, if you like, on climate, environmentalism, and all the rest of it, and Greta Thunberg, who is a doomster, who is a what I would call a climate alarmist. So property price alarmist, the new Greta Thunberg of property, Charlie Lamdin, and this guy over here, let's call him the David Bellamy then. Actually, that's quite a good thing, because David Bellamy was famously put on the naughty step for being realistic about environmentalism and calling out climate alarmism for what it was. And Charlie, one of his heroes on his own blog is David Attenborough, who is a doomster and a climate alarmist. Now, make of that of what you will, but that's how I would characterize this polemic basis of looking at what actually is quite a complicated subject. You can read that in your own time. It's on This Is Money. I'm not sure. I think This Is Money may be related to this publication here, The Motley Fool. And this is an article from 2009, which repeats all the same arguments that are trotted out. There's quite a long discussion I was involved in at the time. My view in 2009 was, if you can get a mortgage and you can afford to pay it when the interest rates go up, then buy, because at the end of the next cycle, you'll actually be feeling okay. That is actually what came to pass. And it's likely to be what comes to pass this time around as well. But that whole discussion from 2009 is actually there. Right, so that's that blog there. Next. Right. If I can just explain why that sign is coming up. I blog on WordPress on the Not the Grub Street Journal website, which is online, but I didn't want to have the business side plan of it anymore. I wanted to go for free hosting. It's very hard to move a site off WordPress elsewhere. So what I've done is I actually used an app called HTTP Rack, which scraped the whole website off the web. I just go here. I use Linux. I'll just show you. Here's the WebTrack website copier, right? So the thing about that is that the how that works in the user interface desktop app is quite different. It's much easier to use a terminal, and that's one of these command line in Windows. Now, so I'll just show you here. So I now have my whole website on this thumbnail here. So if I just open that, that opens there. If I just click here now, that website appears. It scraped this warning of it coming offline. It is still online, but not as a business site anymore. And the only thing I've noticed that doesn't work is the search isn't on the homepage anymore, which I might put back on later. It's actually on the Wayback Machine as well. But if I then say continue to this site, we're now actually viewing this locally. So that's the homepage of the Not the Grub Street unit, not the Grub Street Journal. And the Going Direct paradigm is a mind map which I made of the BlackRock Going Direct plan, which was put to the Federal Reserve in the summer of 2019, and it's a plan that's been put in place in Sweden, which has a large property price correction, and is being instituted all over the world by central banks aligned to the Bank of International Settlements, which is all of them, basically, pretty much all of them. So that's what that going direct paradigm is. I also made another mind map, which is called the Hermatics mind map. Now, Hermatics is my house building company, and that mind map goes into some considerable depth about the affordability problem in housing and where that stems from, and different polemic type approaches to trying to solve it. So I'll put links to all of these things that I've got to open as we go along. But looking at this website here, if I put in affordability housing in there, the search function still works on my local machine, and so you can see here the ending of the long monetary expansion cycle and a brave new world of housing realism. At the risk of reiterating myself, my business blog, big data and fool's gold, and the well-dressed supply side lie, ChatGPT, AI and the affordable housing crisis. Well, you can read as well as I can. So if I put in affordability housing, you'll see in this blog that this is something which has featured here rather a lot. Let's see when the first, this is a document that I produced back in 2020. Let's just see how far back we go here. Right, so the first one here is, oh no, well, that's odd. Okay, so the results are appearing in reverse order. That's an interesting. In fact, they're not appearing in. Okay. Right. Okay. So my local copy, they come up rather differently. Let's just find the online copy. Actually, I'm geeking out here. I'll do that in my own time later. Apologies. So where are we up to? So maybe we'll turn back the hands of time. 2009, exactly same debate, slightly different emphasis on different parameters, but effectively we're heading to a narrative for austerity is required to bring down inflation, and if unemployment goes up and house prices go down, then you end up paying. So just think of that last clip. When it passes from me to you, it becomes worthless. Before that, it's a liability, but after that, it's your problem. It's out of my hands. So that's the context I take from that 1984 film. Right, that is the site online. So that's not the Grub Street Journal, which I'm no longer going to update on WordPress. I'm deciding where to put the to put the site. I might put it on the interplanetary file system, but well, I will do that. It is there from a while back, but that only hosts static sites, and anyway, that's another point. So what do we got next? Right, money. You say Aryans, I say Aryans. Inflation, QE Bono, who benefits? Okay, so this was written on September the 17th, 2022. And this guy here is a famous pragmatic philosopher, American philosopher, Richard Rorty. And in this debate, he's talking about how it seems to be going this way. I think this is an interview in the late 90s. And he says that the object of what's a valid view or an acceptable view is actually the person is only sufficiently informed when they agree with your point of view. In fact, that's a very good observation of people discussing house prices, where they may go, where they might not go. Where they go is an interesting question, but why they're headed there and who is really influencing that or driving that forward, and how much skin do they have in the game, of what's their objective in doing that, is actually a much better question, which will reveal much more about the economic system than the short-term, short memory span, the panic, the fear, uncertainty, doubt side of things. Now, the other part of fear, uncertainty, and doubt in markets is fear of missing out when they're going up, and it's a great game to play. You can fuel one side or the other depending on which side you want to drive short-term prices or medium-time prices for your own gain. Now, the gain here, I would argue, in this money point, is the game of the central banks and the commercial banks is to keep the money token in short supply, which means that money is more valuable than stuff. And one way of doing that is to create artificial scarcity of stuff, which means then people will borrow, will want expensive money to buy scarce stuff. The system that we have of finance is based upon the idea of scarcity, too much money chasing too few goods, and I'm a cornucopian, and I think that we live in an age of potential abundance, and have done indeed since the 1930s. In fact, things have continued to get better in terms of what the capabilities are, and I believe that the power and control that controlling the value of the monetary unit gives to the people who benefit from that is a very small number of people, and that's what drives the policy. It's not the well-being of a general population, and I think that's actually borne out, really. You form your own view. It's a view which Henry George came to at the end of the 20th, i.e. the 1900s, going into the 21st, the 20th century, and Major Douglas, social credit movement, etc. So it's the distributive view of G.K. Chesterton and Hilaire Belloc, for instance, and the insights of these these great minds, Frederick Soddy's another one, are not at the forefront of people's consciousnesses. They simply don't know this stuff when they're arguing the toss over our house price is going to go up or down by 35%. It doesn't really matter. Why are they? Why should they? Where does that leave the autonomy of individuals and communities within a wider context of globalism, of a national economy, regional economy, etc. So that's my perspective on this, is what does it mean for civic or civil society? What does it mean for democracy? What does it mean? What does the home owning democracy mean? My views on that are Proudhonite. So Proudhon was an anarchist philosopher that is credited with calling all property theft. Now, Kropotkin explained that statement in that he said that Proudhon used the term of rights of property in the Roman law sense of the right to use and abuse. So that's things like absentee landlordism and all of that sort of thing, which is really a subset of imperialism, a subset of it's a subset of imperialism, really. And that's not a left or right view on that. It's just it's kind of a plague on both their houses view, in that the importance of money, the importance of banking is undeniable. The objectives of those in control of money and banking are open to question, and when they're questioned, which we're about to do, one actually finds that the objectives on the tin are not necessarily what is contained within it. So here we go. Right, the Fear Index. This was a novel by Robert Harris, and it's talking about a flash crash. I'll put the link in the text. You can look at that. And there are a number of themes in this novel which are quite interesting. Talking about AIs, algorithmic trading, and now if you manipulate a short-term fall, benefit, and then take your profit and get out, you can do really rather well. And that's what this novel's about. Well, on a larger scale, the idea that property is 9/10 of the law, or possession is 9/10 of the law. If you want to control things, if you control the money, you also want to control the stuff, as it were, and controlling the monetary unit in rates of exchange between currencies and the price of a particular currency in a particular monetary domain, you have a huge measure of control. And the trick is to flip from one side to the other. You'll find on the blog there's a book called the Ragged Trousered Philanthropist, and a chapter in that book is called The Great Money Trick, and that talks Robert Tressel wrote that novel, by the way, and that's worth watching, in that it actually shows how exchanging stuff for money and money for stuff, that as a shell game, is a game that plays out at a large level in the property market, if you will, in terms of transfers of wealth or the ownership of stuff into financial hands so that it can be re-exchanged for the financial commodity. And what we're actually looking for at the moment, in this general policy arena, is a reassertion of monetary value and monetization and financialization, as opposed to an industrial capitalism which actually works on efficient production and distribution and providing what's needed to the general population. I argue that that's a cart before the horse approach to economics. And there are people like Henry Carey, who again was a very famous economist at the end of the 19th century. And you'll find blogs that I've done about the difference between free markets and free trade. They're not the same thing. Free trade is a mercantilist, imperial view. It's a predatory form of capitalism. and free markets is something quite different. But to have free markets, you also have to have honest money, open money, and neutral money. To the extent that money can ever be neutral, neutrality is a political neutrality, because once you have money in an economy, it allows an economy to do all sorts of wonderful things which are not possible without it. But the price that one pays for that convenience is too high, and has been too high for a long time. So the share of wages as a percentage of GDP has been stagnant for a long time, and the share of financial services and financial sector of the overall economy has been at an unhealthy level for a long time. Just the benchmark from memory is that if profits in the corporate sector from financials are at or below 5%, then they're actually giving value for money. When it's above that, it's actually parasitic upon the real wealth creation, and that level has been as high as 25% in recent history. Last time I looked at the numbers for a few different countries, the US and the UK, for instance, it was at something like 18 or 19%, which is almost 4 times as high as is healthy for a functioning market, free market economy. We don't have a free market economy, but we do have lots of free trade. So, flash crash. This is the Wikipedia article on what a flash crash is, and it mentions some examples: the May 6, 2010 flash crash, the April 23rd, 2013 flash crash, Swiss franc flash crash of 2015, a British pound one in 2016, a Japanese yen one in 2019, and a European stock market one on May the 2nd, 2022. Does anyone remember reading about that one? I certainly don't. So let's see what it says about that one. On May the 2nd, 2022, from 9:56 to 10:01, CET, the Swedish OMX S30 index, dropped 6.8%, Norwegian 4.1, Danish 6.7, Finnish 7.5. Other European indices dropped 2. The German DAX dropped 1.6. European stock 600. So at the lowest point, around 300 billion euro, at the time 315 billion US, have been erased from markets. The indexes quickly rebounded to levels at or slightly below what it was before the crash. Spokesperson for Nasdaq said the crash was not because of internal server errors or hacker attacks. Nasdaq stated that trades done during the crash would not be cancelled on the exchanges that it operates. There were rumours that Citigroup had accidentally sold a large basket of European stocks over the market. Later in the afternoon, Nasdaq confirmed that the flash crash was due to a very large accidental sell order by a market participant, a so-called fat finger error. Nasdaq would not comment which market participant it was. Later in the day, Citigroup admitted that the crash was caused by an error when inputting a transaction by one of its traders at their London trading desk. Make that of that what you will. The Kennedy slide of 1962. Now, this is quite interesting, also known as the flash crash of 62, is given to the stock market decline from December 61 to 62 during the term of John F. Kennedy. Now, after the market experienced decades of growth since the Wall Street crash of 1929, the stock market peaked during the end of 61 and plummeted during the first half of 62. And the stock market did not experience a stable recovery until after the end of the Cuban Missile Crisis, etc. Now, explanations, let's have a look. During the time of the Kennedy slide, the head of the American Stock Exchange, Edwin Posner, explained to reporters that this definitely is not panic selling. Instead, he attributed the drop in stock prices as an adjustment from the previous 10 years of increase. Although thorough investigation led by a special committee of the US Securities and Exchange Committee, the committee concluded there were clear signs of incompetence, but none of malfeasance. Public began gaining confidence after important businessmen and fund managers addressed press about the concerns of the market. Now, that's just bringing to mind the Kamikaze Truss episode of September 2022. Now, of course, it's been pointed out that actually bond markets are now in a worse position if higher interest rates are worse. Was that a political flash crash? I would argue that the Truss thing was a political flash crash, and I would also argue that Liz Truss and Kwarteng were actually right in doing what they wanted to do, but it was going against the grain of what the intentions of the Bank of England, the Fed, also are. We're going to look at the Fed and the Bank of England in a bit more detail in a second, but anyway, that's flash crashes. And I think Donald Trump is Kennedy-esque in the possibilities of a flash crash if he were to make a successful run at the presidency again. Now, we live in an incredibly political economy. Let's put it that way. So political economy is actually another term for economics, but it's uber political at the moment. And politically, Donald Trump, for all sorts of business and economic theory points of view, he's seen as a loose cannon by Wall Street. He's not seen as a Wall Street type of guy, in the sense that, well, he's a property developer. He's not a Wall Street financier. Now, property developers and financiers kind of do come as a piece. So, for instance, my hero, Paul Reichman, I would describe him as a financier. Charles Claw in the 1960s was a financier. There are quite a few that I could mention, but property and finance are intertwined. And the reason for that is what I pointed out at the very beginning. Real estate, residential property, is over half of the monetary base in the UK, and that makes people who operate within the market quite important. Now, the new home sales part of the market, actually, I'll just pull this spreadsheet in just to make this point. Right, this is my spreadsheet of the UK housing market, and these things up here, I'm talking about market depth and market liquidity. Okay, so what I mean by that is that the liquidity is the number of cash buyers in the market, and you can see this column here. So, for instance, in 2014, 33.4% of all transactions in the property market were cash, and 5.3%. Where are we? Total percentage of stock. So the total percentage of stock turnover, so across the whole market in 2014, was 5.43%. Okay, now that figure varies, but in 21 it was 4.55%. No, that is 2021. In 2022, substantially lower. So that speaks to the volumes falling. But this idea of how many cash buyers there are, what the mortgage value is, those are the figures I was talking about at the beginning. That's why I look at these figures. This column here is actually the mortgage percentage loan to value ratio, which has been very high and has been falling down to 79% in 21. that's the figure of 78% that I gave earlier. And that's an important metric. If that is higher in times of market distress. So in 2013, for instance, it was 98.74%. It got over 100% in 09. So that's very pertinent. And nobody wants 2009 to happen again. But if house prices fall by 35%, as Charlie Greta Lambdin is saying, that's where we'll be at. But I don't think that's the game that's being played. I think we're in a transition of banking. I think we're in a transition from an abstract monetary unit to a monetary unit based on a carbon measure, and carbon CO2 is obviously they've been measuring it for years, and the point about that is that it's a really good way of rationing stuff, and a carbon based central bank digital currency attached to a identity social point system gives even more control than there is anymore, is already, and I say should be resisted at all costs. So anyway, that point actually boils back to this, is if stuff is rebased, the banking system still has to rebase itself in a solvent configuration, and that solvent configuration, whilst the rules may change, I think there are too many people that know what the rules are to actually carry that one off. And a command and control fully rationed economy is, well, it's not what people vote for, is it? And if we have a democracy, any democratic system isn't going to get that result. Hence the fear, uncertainty, and doubt on one side, fear of missing out on the other, and the fear index, the short-term panic to try and sort of slip things in on the blind side, as it were. But anyway, that's just a bit about that spreadsheet. There is a link to this spreadsheet actually in one of my blogs. So where are we? Let's get to the next tab here then. Right, here we are then. So this is fear, uncertainty, and doubt, fear of missing out, housing market dialectic. Okay. So I'll put the link in the description. Right, I think that's Billy Joel. Yeah, that is. So I'm not going to play that at the moment, but the line in. So one of the choruses in that song is, "What's the matter with the crowd I'm seeing? Don't you know that they're out of touch? Should I try to be a straight A student? If you are, then you think too much. Foamer guff, fud guff, 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 guff. All smells the same to me." So anyway, that's what this blog post is about. So the link will be in the description. Now, this is a post I did, show us your bottom, crash or correction. Just trying to be a bit lighthearted about this stuff. And there are links to various things which I think back up my assertions, and property Greta figures. This is Merrin Somerset Webb, who says some good things, says some bad things. And then this is the point here. So this analysis here by Alex Groundwater, it is a good analysis. I was looking at it earlier, and it makes a point in this one here. We just have a look at this. Oh, yeah, I've been blocked, so I can't look at it there. Where am I going to look at that? Show your bottom. Let's just go here. Anyway, basically what it says is the correlation breaks down at certain extreme events. And although that happens, Alex has still produced his, what does he call it? That's too small to see. Hold on, let's have a look. It's here somewhere. What's that one? Right, we'll move on from that point. But basically, this point here, this tight correlation, which Housing Greta mentions here. So where are we? Talking about the correlation of wages to house prices, which does exist, but that correlation actually breaks down at key points, which actually makes Alex's analysis slightly problematical, even though he's not quite as full as doom as Housing Greta here. But anyway, you're not blocked, so you can look at that and read it yourself. I'll put the link in the description. Right, double think to still about oil, peak triangulation. So this is where I started this morning when I got up, and I actually put in a search term, and this blog came up, and there's an article by Corey Morningstar, who wrote an excellent 5-part series on the manufacturing of Greta Thunberg by consent, talking about climate alarmism, right? And then there's this, then by this guy called Roger Baker, written in 2016, Demand Destruction and Peak Oil. Now, peak oil, I think, is another fear, uncertainty, and doubt related to the oil market. And I think the oil market, particularly with respect to the petrodollar, is very, very important to manipulation of the price of the value of the dollar, as opposed to other currencies, and other currencies kind of orbit around the dollar. And I'm just going to show something shortly, which shows how the Fed policies, which is true now, it was true back in 2012 when the article I'm going to show in just a minute comes up. And then there's some other analysis by Bischler and Nitzen, which is also to do with the oil market, and how it's not a oil is a political price, it's not a market price. So this Charles Hugh Smith, Tiffin's Paradox, Crunch Time for the US Dollar and Global Economy, that's written in 2016, quite pivotal times. Mislies and Oil Wars, Engel, Association for Peak Oil. So I had a discussion with a guy about, well, it wasn't really a discussion, but peak oil is another myth. Plateau oil, you can make an argument for, you'll find that elsewhere in my blog, but we're a long way from plateau oil, except that it's a function of how much investment goes into just getting more of the abundant oil out of the ground. And price maintenance of oil prices goes all the way back to the Texas Railroad Commission in the 20s and 30s, all of which is extensively described and discussed in a wonderful book called The Control of Oil by a guy called Malcolm Blair. But anyway, let's just move along. Right. Tripping's paragraph is that the issuer of a reserve currency must serve two entirely different sets of users, the domestic economy and the international economy, right? And then you introduce the BRICS into that equation, and you get some understanding then of this, a switch from an abstract monetary unit to a monetary unit founded upon carbon value, CO2, credits, etc. And at the bottom of all of that is where you find, I think, a solution to what's really driving the policies of central banks, Andrew Bailey, and Powell at the moment at the Fed. So what else have we got here? So demand destruction and peak oil. Now, demand destruction is a term familiar to social creditors. The Dork from Cork on Twitter has a lot of stuff about demand destruction, talking about how Ireland has become an entrepot. And my friend David Malone described Ireland as Europe's offshore tart, famously to me. Then we get on to, right, search results for Bruce Charlton distraction. Okay, so I'll put that link in the description and you'll see what comes up. But petrodollar hegemony, central bank digital currencies, deflation, free markets versus free trade, globalists and internationalists, the enemy is you. Free trade versus free markets, the camera obscura of the elite propaganda discombobulation. Look away now. My experience is what I agree to attend to. For definitions of very dreadful things, they do the two things that most men, especially comfortable men, cannot endure. They fight, and they fight fair, which is a quote from, I think it was G.K. Chesterton. So political economy, that's what this is all about. And property market and property finances are all about political economy. None of these are natural causes or natural events. And to that extent, forecasting them is very difficult because the people with their hands on the lever, I made a point about the fat lady hasn't sung yet. And no one knows which tune the fat lady will choose to sing. And of course, the fat ladies are Andrew Bailey and the rather slimmer Jerome Powell. And then, of course, the fat lady of all fat ladies, Carsten, whatever he's called, at the Bank of International Settlements. So weapons of mass distraction. Narratives, pivots, talking points, taboo, room 101, Ardha, enshittification. You might want to have a look at that, but this is the point I want to make here. Bruce Charlton, in his book, which is called, what's it called? Something distraction. Anyway, he says this: thus, the major output of modern international mass media consists of only four categories: good presented as good, bad presented as good, that is, say, simple inversion, good presented as good for a bad reason, and bad presented as bad for a bad reason, that's to say explanatory inversion. And there are loads of these inversions that we come across. It's addicted to a distraction, by the way, the book, Bruce Charlton book that I'm referring to. Internet manipulation. These are the Vault 7 leaks. Edward Snowden, and then also a guy called Zach Verhoeves. That's where this came from, when he blew the whistle on Google. And again, the polarity, the binary discussions, the polemics that come out of either side from Property Greta and property. Let's call him property raw. So, well, someone taking an extreme view the other way, then you end up with a very confused debate that actually leaves out really important things that do bear discussion and thinking about. Control grid, carbon currency endgame, apocalypse, the extinction event, Boudica returns. That's a comment I left on Off Guardian. Right, so this is an old blog from 2018, variation on the theme that the media is the virus, as it were. So that's that one. Petrodollar hegemony, central bank digital currencies, deflation, free markets versus free trade. So I mentioned this. And then I mentioned two brains better than one. Where are we? The other brain I was referring to there was the Hematics brain. That's the search, weapons of mass distraction. So all of these will be quoting Bruce Charlton in one form or another. Actually, there are not that many of them on that subject. Then Billy Joel's Still Rock and Roll to Me. What's this one? Okay. And that's just the index. So I'll get rid of that. Right, Bulls and Bears in the Woods with Greta house prices. House price Greta, as Charlie will henceforth be known. No, that's a bridge too far. I'm going to freeze my computer at this stage. Just when we get into the good bit, Gov. Broadcasting, are we still broadcasting? It doesn't look like it. Bloody frozen, absolutely fucking unbelievable. Okay, so we're going to do here. Share screen. Going rather slow here. Here we are. Let's just get here. Okie dokie. Let's just check my. Okay, I think we're back. There was just an interruption then. My computer froze. I have got rather a lot open, even though I'm running a lot of this blog stuff off. I'm not going to close them because I need to put the links in the description. So here we are. So I'm going to put that one on. And what we're going to do is just close a few windows. So, right, let's. I haven't got this far, so. No, this is all going too slow now. Right, okay. I'm going to end that there, and going to do the other bit shortly. I'm going to stop and have a cigarette, have a think, play that back, but let's just go back here. So until next time, let's just play out with this.